Hello students, welcome to BBA 407 Strategic Management. I am your instructor for this course, Mine Doyran. Today I will be talking about financial accounting, especially financial statement analysis for strategic management. In this lecture, we will basically review 14 ratios classified into two categories: risk ratios and profitability ratios. Don't forget, when calculating these ratios, we measure income statement accounts over a period of time and measure balance sheet accounts at a point in time. Therefore, ratios that compare an income statement account with a balance sheet account should express the balance sheet account as an average of the beginning and ending balances. Here you go. In this section, we will talk about the risk ratios used to analyze a company's risk. As you can clearly see in the figure 12.7, there are two types of risk ratios: liquidity ratios and solvency ratios. In this lecture, I will talk about the importance of each of these ratios. Summarizing 8 risk ratios and how they are calculated or used in financial statement analysis. First, we start with liquidity analysis. Liquidity refers to having sufficient cash to pay currently maturing debts. But what does it mean being liquid? Being liquid means having current assets immediately convertible to cash in a relatively short time. I'm repeating. Being liquid means having current assets immediately convertible to cash in a short period of time. For instance, house is not a liquid asset because if you put your house on sale, it will take a long time to sell it. Maybe 2 months, 3 months, 8 months. Therefore, house is not a liquid investment. Liquid investments are investments that can be converted into cash in a short period of time. Cash, meaning paper money, is the most liquid investment. Because a lack of liquidity can result in financial difficulties or even bankruptcy, it is critical that managers, as well as outside investors and lenders, maintain close watch on this aspect of a company's well-being. Here, we look at 3 liquidity measures: working capital, the current ratio, and the acid test ratio. All 3 measures are calculated using current assets and current liabilities. Working capital is the difference between current assets and current liabilities. A large positive working capital is an indicator of liquidity, whether a company will be able to pay its current liabilities or debts on time. However, don't forget, working capital is not the best measurement of liquidity when comparing one company with another. Why? because this measurement, meaning working capital, does not control for the relative size of each company. Again, working capital is not a good measurement because it does not control for the relative size of each company. The second liquidity ratio is the current ratio, which compares current assets of the company to the current liabilities. Current liabilities means that the company has debt, short-term debt to pay. This is probably the most widely used of all liquidity ratios. A high current ratio indicates that a company has sufficient current assets to pay current liabilities as they become due. In this illustration, we present the current ratios for Under Armour and Nike. Under Armour's current ratio of 3.6 means the firm has $3.60 in current assets for each $1 in current liabilities. Of course, as you can clearly see here, Under Armour's current ratio is higher than Nike's current ratio of 3. So this means that a company needs to maintain sufficient current assets to pay current liabilities as they become due. Thus, a higher ratio usually indicates less risks, particularly less liquidity risk. In this scenario, Under Armour faces less liquidity risk than Nike's balance sheet. The third measure of liquidity is the asset test ratio. The asset test ratio is similar to the current ratio, but is a more conservative measurement of current assets available to pay current liabilities. Don't forget, this is a more conservative, more pessimistic measurement of current assets available to pay current liabilities. Specifically, the top of the half of the fraction, as you can clearly see here, includes only cash, current investments, and the accounts receivable. Accounts receivable means that the company is expecting to receive payments in the short run. These are the payments that the company is expecting to receive in the short run. Because this ratio eliminates current assets such as inventories and prepaid expenses that are less readily convertible into cash, the asset test ratio may provide a better indication of a company's liquidity than does the current ratio. Don't forget, in this formula, certain things are eliminated from the current assets. So which aspects of the balance sheet are eliminated? Inventories and prepaid expenses. I'm repeating, inventories and prepaid expenses are eliminated from the current assets. For this reason, the asset test ratio may provide a better indication of a company's liquidity than the current ratio. This illustration shows the calculation of the asset test ratio for Under Armour and Nike. Under Armour's asset test ratio is 2.21 and compares favorably with Nike's ratio of 1.8 to 1. This means that both companies appear to have more than enough liquid assets available to pay current liabilities as they become due. Both companies are good in terms of liquidity. Both of them are able to pay current liabilities as they become due. However, Under Armour's acid test ratio is better than Nike's acid test ratio. The other indicator of liquidity is the receivables turnover ratio. This ratio measures how many times on average a company collects its receivables during the year. A low receivables turnover ratio may indicate that the company is having trouble collecting its accounts receivable. So this ratio really indicates whether or not the company is able to collect its receivables during the year. A high receivables turnover ratio is a positive sign that a company can quickly turn its receivables into cash. Again, in this illustration, we see the calculation of the receivables turnover ratio for Under Armour, and we compare it to Nike's. In calculating the receivables turnover ratio, we have assumed that Under Armour's sales are all credit sales. The bottom half of the fraction is the average accounts receivable during the year, calculated as beginning receivables plus ending receivables divided by 2. The average accounts receivable is calculated as beginning receivables plus ending receivables divided by 2. The second liquidity ratio is the average collection period. We often convert the receivables turnover ratio into days and call it the average collection period. This ratio measures the days it takes to convert receivables into cash. Don't forget, in this scenario, shorter collection period is better. Shorter collection period is better. The shorter the average collection period, in other words, the better performance for the company. This illustration again shows the average collection period for Under Armour and Nike. Under Armour's average collection period is 30.9 days, right? Whereas the Nike's average collection period is 48.7 days. So it takes, in other words, Under Armour, an average of over 1 month, 30.9 days, to collect its accounts receivable, whereas it takes Nike an average of 48.7 days to collect its receivables. So 48.7 days is much longer than 30.9 days. So we can confidently say that Under Armour is doing a better job of receiving its collectibles, or it's doing a better job of converting receivables into cash than Nike. The other ratio, liquidity ratio, that we use in our financial statement analysis is the inventory turnover ratio. This ratio measures how many times, on average, a company sells its entire inventory during the year. A high inventory turnover ratio is a positive sign. So higher the better. higher inventory ratio is a positive sign. It indicates that inventory is selling quickly, meaning that less cash is tied up in inventory, and the risk of outdated inventory is low. So in other words, the higher ratio is always a positive sign. It indicates that inventory is selling quickly, less cash is tied up in inventory. There is also less risk of outdated inventory. However, an extremely high inventory turnover ratio might be a signal that the company is losing sales due to inventory shortages. So we want the inventory turnover ratio to be as high as possible, but not extremely high. Extremely high turnover ratio indicates inventory shortages. Again, this illustration provides the inventory turnover ratios for Under Armour and Nike. Inventory at Under Armour turns over on average 3 times per year, compared to 4.5 times per year at the Nike. So there is a slower inventory turnover in Under Armour. This is a negative sign. The slower inventory turnover in Under Armour is a negative sign because it indicates a greater risk of slow-moving inventory items. Another liquidity ratio is the average days in inventory. We can convert the inventory turnover ratio into days and call it the average days in inventory. Right? This measurement indicates the days it takes to sell inventory. It measures the days it takes or the time it takes to sell inventory. Lower value is better. As you can imagine, companies try to minimize the number of days they hold inventory. Lower value is much better. We calculate the average days in inventory in this illustration. Under Armour's average days in inventory is 121.7, calculated as 365 days divided by the inventory turnover ratio of 3. In comparison, Nike's average days in inventory is much lower at 81.1 days. Again, don't forget, to be able to find average days in inventory, you have to first find the inventory turnover ratio, which we discussed in the previous slide. If you don't have the inventory turnover ratio in your hand, you won't be able to find this average days in inventory ratio. The final ratio that we will discuss in this analysis is the debt ratio. Debt ratio is an indicator of the solvency of the firm. Again, this is another risk ratio, but specifically focusing on the solvency of the firm. We're no longer discussing liquidity. We're now focusing on the solvency ratio. Business decisions include risk. Failure to properly consider risk in those decisions is one of the most costly yet most common mistakes investors and creditors make. This ratio focuses on the long-term debt of the company. If the liquidity ratio focuses on the short-term debt or short-term risk, debt ratio focuses on the long-term debt of the company. Long-term debt is one of the first places decision makers should look when trying to get a handle on risk. Two ratios frequently used to measure financial risk related to long-term liabilities is debt to equity and times interest earned ratios. Again, here with this slide, we are moving to discuss long-term risk ratios. When we were discussing the liquidity ratios, we were all talking about short-term risk. The risk is always divided into two. Short-term risk versus long-term risk. The liquidity ratios always applies to short-term risk, whereas the debt ratios apply to long-term risk. The first long-term risk ratio is the debt to equity ratio. This ratio indicates the risk of bankruptcy or solvency. Higher ratio indicates higher risk. Other things being equal, the higher the debt to equity ratio, the higher the risk of bankruptcy, meaning that the firm is going out of business, meaning that the firm is going to be insolvent, is no longer be able to solvent. Debt holders have the ability to force a company into bankruptcy for failing to pay interest or repay the debt in a timely manner. Let's say if you fail to pay your mortgages, the bank has a right to seize your assets, meaning your house. Again, if you fail to pay your mortgage payments, the bank will seize your house. This illustration shows the calculation of the debt to equity ratio for Under Armour and Nike. Under Armour has a debt to equity ratio of 41.6%, whereas Nike's debt to equity ratio is much higher, 49%. So this is not a good sign for Nike. Nike in this scenario faces much higher long-term risk, meaning the risk of bankruptcy, than Under Armour. So higher ratio indicates higher risk of bankruptcy or insolvency. Note that additional debt can be good for investors as long as a company earns a return on borrowed funds in excess of interest costs. If the company's return on assets is higher than the cost of interest payment, then debt can be a good sign for investors. More debt increases the risk of bankruptcy, however, but it also increases the potential returns investors can enjoy. To measure a company's risk, we often calculate the debt to equity ratio. The debt to equity ratio is also a measurement of financial leverage. Don't forget, it is also a measurement of financial leverage. Taking on more debt, meaning taking on more financial leverage, can be good or bad depending on whether the company earns a return in excess of the cost of borrowed funds or interest rate. Debt requires payment on specific dates. Failure to repay the debt or the interest associated with the debt on a timely basis may result in default and perhaps even bankruptcy. Other things being equal, the higher the debt to equity ratio, the higher the risk of bankruptcy. When a company assumes more debt, risk also increases. Debt can also be an advantage. It can enhance the return to stockholders. If a company earns a return in excess of the cost of borrowing, shareholders are provided with a total return greater than what could have been earned with equity funds alone. Unfortunately, borrowing is not always favorable, don't forget. Sometimes the cost of borrowing the funds exceeds the returns the companies generates. This illustrates the risk-reward trade-off faced by shareholders. So we want the debt-equity ratio to be as low as possible. Sometimes higher ratio indicates better returns, but this illustrates the risk-reward trade-off faced by shareholders. For the time being, we are not going to cover times interest earned ratio. This ratio you do not have to learn. I will not ask times interest earned ratio in the exam. So I'm skipping this slide, times interest earned ratio. You do not have to know this slide. And thank you for listening to my lecture. In the second part of my lecture, I will talk about the ratios to analyze a company's profitability. Thank you again, and I will see you next class. Have a good day.